The CFP Sanford DeLand Free Spirit Fund was launched in January 2017. Its objective is to give investors a return that's 2% ahead of inflation after all costs. And I would say that's a minimum objective on my part. The fund invests in UK equities, it invests across the size spectrum, it invests across all sectors, and in that sense that's why it's called Free Spirit, that we want to invest wherever we can find undervalued businesses. The plan is to have between 25 and 40 holdings. So it is a relatively concentrated fund, because I believe that to keep tabs on more than that many companies closely is actually quite difficult to do. So the process is that the fund is aiming to hold between 25 and 40 stocks, and for each stock I will prepare a model which will do up to a 10-year history of the profit and loss account, balance sheet and cash flow, and a forecast forward of the cash flows explicitly for 3 years, and then with a fade in the growth rate. I discount that back at 10% per annum, which is roughly the cost of equity, and is a goodish number to give a margin of safety. And that gets me to an absolute valuation, which, to be frank, will be wrong, because one can't accurately forecast what's going to happen to companies. But it is a reality check. What I'm looking for is companies with high returns on equity, high returns on capital employed, preferably high margins. So quality, or if not already achieving that, with a very clear path to be able to achieve that, for example, by selling off poor performing divisions and focusing back on a good core. You asked about the lessons, and I would say of the three, the first is that you're investing in a business rather than buying shares, and that may seem a subtlety, but it's helpful when markets are volatile to remember that. So I'm looking at the business, how it makes money, and how it's going to invest its cash flow and grow in the future. And in a sense, the share price is winging around the fair value of that business. So that's the first lesson, focus on the business. The second lesson is that I have found that if I've bought a share, bought a stake in a business, if sometime later I come to summarise why I've invested in that company in a paragraph for a report, if I can't easily do that, usually it's a sign that I wasn't too clear about why I was investing, and I probably shouldn't have invested in the business. So a good discipline is to be able to summarise very briefly why you've invested, yeah, and to do it pretty promptly. My third lesson is to be very wary of companies that talk about earnings enhancement as the reason why they have made an acquisition, or the reason that they've made any kind of investment, actually, because with interest rates this low, frankly, most things are earnings enhancing, and it's not the relevant metric, but it is incredibly surprising how widespread that rationale is. I could pick any one of the 33 that are in the fund. I'll name Tristel, which is at the smaller end of the spectrum, market caps of just something over 100 million. Tristel is a company that makes chlorine dioxide, and that is used to disinfect machinery, equipment that is used in outpatient departments in hospitals. The trick is that you need to blend the ingredients just before you use the product. And so they have devised and patent-protected delivery systems, such as, for example, a handheld pump that blends the ingredients and generates this product, which the operative can then apply to disinfect the equipment between seeing patients. And obviously in a busy hospital, time is of the essence. And so their method of disinfecting is very much more efficient and appropriate to an outpatient department than other methods that are around. And it's also more effective. And I like Tristel because they've grown steadily, they are soundly financed, they have good returns, very high margins, and they are now looking to take this product into the United States. So that's the first one. Perhaps much further up the size spectrum, another company I own is Auto Trader. I like platform businesses because you tend to find with platform businesses that the winner takes all, and that the market leader has a way bigger share than others and is quite difficult to unseat for that reason. And Auto Trader is in that camp. Now, because of its private equity history, you can't look at the history in terms of return on equity and get a very sensible number. But if you look at the marginal return on equity each year, it's in the 30%, which is very good. And I see a lot of potential for Auto Trader to become more involved in the car buying decision. For example, they're known for used car information, but they're now moving into the new car market. Well, I don't have an outlook for UK equities because I'm very focused on looking at individual businesses and bottom-up stock picking. And I have never felt that I could actually anticipate macroeconomic events or political events. The world out there is volatile. It's pretty unpredictable. It seems particularly unpredictable at the present time because of certain, country leaders who can be themselves unpredictable in their policies. So I don't worry about what the outlook is for equities as a whole. What I'm looking at is my models and looking to find a quality business that, for some reason, is at or preferably below the fair value of that business. So the first thing to say is that as a small business, under MiFID II, we're paying through our own P&L account for company research, but because we're small, we have limited the number of brokers that we now use. We have a spread, we think a perfectly good spread. We have access to research on all the companies that we invest in. But we have cut out a lot of names. And I think that if you follow that through from the company's perspective, it means that there will be a lot less people reading research produced by various brokers than in the past. So I think the first thing companies need to do is to ask, particularly their corporate broker, who is no longer taking the research that was in the past, so that they actually know the quantum of the change. That's the first thing. And the second thing is that if the corporate broker is now charging investors for research and saying that its analyst is independent, I feel very strongly that analyst should not have preferential access to the company, for example, the night before the results, as they would have in the past. I think that that has to change, and that all independent analysts should be treated equally, regardless of the corporate relationship. The third thing I would say is that I think companies should now put consensus estimates on their websites, because different fund managers will have access to different brokers. They won't all have the same blend. So what is consensus in this new world? It has a very different meaning.